Hi friends, and welcome to another risk-reward matrix video for Arctic Money. Right in front of you, you will see my updated risk-reward matrix. Today, 6th of April 2026. And a little bit about the matrix itself for those who don't know what it is about. You see there the reward axis and risk axis. Risk axis means for me basically how risky I perceive the stock, the company being, investment being for myself. This takes into account the industry where the company operates, as well as how well I understand it, how good of a knowledge I have on the industry, how let's say how close to the center of circle of competence this company is for me. So this is kind of personal, but kind of objective risk axis, if you know what I mean. Then the reward, that basically means my valuation on the company. How much do I expect making on this investment where the stock price is currently standing today. And there you can see the center of the screen. You can think of it kind of like if you move from to the right side of the from the risk axis, the right side is where I expect at least 10% or more gains annually for the investment, and then vice versa on the left side of the risk axis, you will find the companies I do not expect to make you 10% a year for, well, kind of depending on did I use 5-year or 10-year valuation, but during the next 10 or 5 years of years of coming, will the average returns be more than 10% or less than 10%? So without further ado, now you know what this is about, so let's check it out. Last video I did my portfolio update, so probably it will not be surprising to you that on the upper right hand corner you can find basically my portfolio. I obviously think these are the most attractive companies, thus they are in my portfolio. I feel like they can now be divided, like in the picture, to two classes. I have kind of speculative, high-tech, very hyped-up industry in LiDAR sensors and robotics and everything related to it with Auster. I feel like the total addressable market is amazing for these kind of physical AI robotics applications. So Auster has great potential for great returns, but also carries risk accordingly. Then you have Hims and Hers, online platform for medicine, mainly in the United States, but actually rapidly going international too. Lots of stuff happening around the company all the time. Due to nature of the health industry, I would say, carries a lot of risk. And when you're trying to disrupt an industry like health industry is, that comes with a lot of regulatory and other risks. So high risk profile, still like Auster, I see, if everything goes fine for the company, amazing potential in the future. Then let's say those of you who have been watching my risk reward matrices for a longer time, definitely a position I'm on the losing side. Kamux used cars in Finland, mainly also Germany and Sweden. This has been so far a bad investment, and so far probably the investment I have been most wrong about when I've been doing this matrices for you quite a while. I actually can't remember even when I made my first matrix, but I think I have been maybe 3 years already doing this, so go and have a look on my YouTube channel. I can't remember even myself how long I have been doing this for you. I try to do like maybe 4 a year, like I do my portfolio updates 4 times a year for you to see transparently what I have in my portfolio. Maybe 4 portfolio videos and 4 these risk reward matrix videos coming up per year. So yeah, go and have a look. I can't even remember how long I have been doing this. But yeah, anyway, Kamux on the losing side, but I think the stock is trading like there is no tomorrow for the company, but I believe there is a tomorrow for the company. I believe you are able to achieve somewhat economies of scale even in the used cars industry. used car sales industry, even though the reason why Kamux is so high on the risk axis is that I don't think basically any used car sales company has a competitive advantage, a real moat. But then when you have a kind of an industry where there is no moat, I also believe that if the industry is highly fragmented, as this industry definitely is, then size will be your advantage, and Kamux being one of the biggest players in Finland, hopefully someday also in Germany and Sweden, where lots of used car sales happen between even individuals themselves, but also between individuals and really small companies. I do believe you should be able to at least achieve some economies of scale in the long run with your size, merely with the size of your company, and the fact that you can operate a larger network of shops as well as online, obviously, with a little bit lesser amount of costs related to operating. So yeah, that's why I invested in Kamux. As I said, this has probably been currently my worst investment and worst company I have been putting high up on these matrices too. But when the stock price keeps on going down, that also means that the risk is going down with the investment, and it's with the valuations Kamux is trading, it is quite difficult for me to see how I would end up losing, let's say, even more than I have already lost with this position, because the valuation seems so cheap for the company. But yeah, it's still in my portfolio, but for the reasons just mentioned, carries a lot of risk. Then you have 3 companies from my portfolio inside the square, you see, but I think these have more attractive risk profiles and still really attractive valuations currently. Flow Traders, Green Landscaping, and Uranium as a commodity. Uranium and Flow Traders are the biggest positions I have. They are over 50% of my portfolio. I can't remember how much was it, but if you want to check it, go and see the portfolio video, but it's like 60% of my portfolio or something close to that. Of everything in my portfolio is Flow Traders and Uranium as a commodity. Green Landscaping just did a valuation on that, and it still seems quite attractive to me. This serial acquirer of businesses in the landscaping and maintenance industry, mainly operating in Sweden and Norway. But there inside the square basically is my portfolio, somebody might have guessed. Feel obviously I have confidence still in these companies, otherwise they wouldn't be in my portfolio. But let's take next on top of these, where you can see with a lower risk profile, due to being the biggest fast food retailer in the UK, Greggs. This company, I don't have any excess cash now, and I don't want to sell any of my positions I have, so I have a cash problem. If I would have more cash now, I think I would be buying Greggs at the levels the stock price is today. It was even cheaper a few weeks ago, and I was really close in opening a position for Greggs, but didn't have the cash, so didn't do it. But I have to say, I find Greggs really interesting at the moment. I feel like they are very attractively valued at current levels. My hope is that even though I read some rumors that they are once again considering going outside their main operating market, UK, I think that would be a bad idea. I wouldn't like that. I would like them to just concentrate on the market they are the biggest player in, and try to keep on being attractive in that market, keep on driving the costs down and profit better. But I feel like it's unnecessary risk and unnecessary loss of focus for Greggs to go and try business somewhere in the mainland Europe, for example. Food culture is very different between different countries. Definitely inside Europe, the food cultures are really different depending on the country where you are at. And it's always a big risk to enter a new market. So I would rather not lift the Greggs risk profile up here. I would concentrate on my home market. But as said, Greggs is if I'm able to get excess cash now from somewhere, selling something in the near future or something, Grex is something I would like to include at current levels to my portfolio. So that one I wanted to highlight. Then when we look at the companies, there I have put like a little bit on the right side of the risk axis, meaning that they would, I think these companies, if everything goes well, will give you 10% a year for the upcoming years. Dr. Martens being fashion industry, it's more riskier than the other ones you see there, so that's why it's higher up in the risk naturally. But then Energy Services of America, Origin Enterprises, Alta Beauty, Alphabet, Meta, Berkshire Hathaway. I think if everything goes fine for the companies, you should be able to even get 10% a year at current levels. I want to highlight now the big tech we have here. So Alphabet, Meta, then a little bit on the left side, Microsoft, Amazon. These companies used to be like I overvalued for a long time, and I think people who have been watching my videos for a longer time say that I keep on saying all the time, or I have been saying for now 1, 2, 3, 4 years maybe, that these are overvalued companies. Now that due to the war in Iran and due to everything that is happening in the world, also these companies have been going down in the stock price, and actually their valuations are not that crazily overvalued anymore. As you can see, I put on the right side Alphabet and Meta, Amazon and Microsoft, well, not too far away. I believe that if everything goes well, 10% is possible, but here is the thing with these four. These are so-called hyperscalers investing. They have changed their business models that used to be low capex businesses, software businesses, suddenly turned into hardware businesses with data centers and stuff, and they have huge capex spending due to AI trend and the technological advances we have been having with artificial intelligence. These companies want to be there on the front in those new frontiers in technology, but that also means they have huge capex, which immediately, to me, increases their risk profile, and I would say even significantly. These are not the same Alphabet, Meta, Microsoft, and Amazon you knew 5 years ago. They are different companies today. And this is one big takeaway I would like to give to people watching this video. You might want to consider what it means nowadays for these companies. So if everything doesn't go super well with AI developments and they have been spending too much on capex, that might create problems for you in the near future, the upcoming years, I would say. But yeah, then I want to take a little detour here, and you see Apple also. Apple is just overvalued at the moment, in my opinion, but Apple differs a little bit from these other big tech companies, since they haven't really gone full capex expanding mode and spending more on investments. They are pretty much the same Apple that they have always been, or have been 5 years ago. But still, I feel Apple is overvalued. So yeah, that's why it's there. Then let's say GFL Environmental. That's a new company. I just did a valuation on. I haven't made a video for you, but you guys have been watching my videos on the company stock analysis for so long that I think you also know how to do the valuations already yourself. So I don't need to do a valuation on every company I include on my watch list. And as you know, all the companies you can see on the screen now basically is my watch list of companies, the universe I'm operating in at the moment. GFL Environmental, a newcomer there, following that a little bit, but okay valued, but not a buy for me yet. It's a waste management company in Canada and United States. Then what else? Amsterdam Commodities, great trading business in Europe. Used to own it a year or two ago, but then sold it on profit. But I think it's getting a little bit too expensive nowadays. CPKC, so Canadian Pacific Kansas City, is a railway. Obviously low risk businesses. I'm sure you know I'm sure there is not too much questioning on your viewers' behalf why I have included more risk to some companies, and these companies you see here downwards are low risk companies. Railways naturally are basically kind of a monopoly, oligopoly in the North America at least. Canadian Pacific Kansas City overvalued, not low risk, nothing to add there. Excuse me. Then ADM Archer Daniel Midlands, food business, very low risk overall, but not quite there where I would like to own it. Obviously these companies I'm talking now, like let's forget about the big tech, but GFL Environmental, Amsterdam Commodities, ADM, Canadian Pacific Kansas City, ASML, Berkshire Hathaway, these are low risk businesses and I would love to have them in my portfolios, but I can only buy them if the valuation is correct. Otherwise it's a no deal for me. But that is essentially why I keep them on my watch list. I'm waiting for that panic to hit the market, and then when these companies you see down here on the matrix start trading at attractive valuations, I want to go in big, put big money in them, because these are the companies that have competitive advantages, and these are the companies that have big moats. Then, what do we have there next? ASML, obviously, hugely critical tech company from the Netherlands and plays a part in the world geopolitics and stuff. But still overvalued. Epiroc, Swedish mining company, overvalued. Then you have Experian. It's the kind of the plumbing system of finance here in Europe and also internationally. These companies, ASML, Epiroc, and Experian, was in my video if something dark is about to happen later this year in the United States, and if the let's say level of freedom changes in the United States later this year, these would be the companies from Europe that would see gains because of that kind of dark things happening. That if the democracy were to deteriorate in the United States, these would be the companies that would be beneficiaries of something really dark developing like that. But special cases, special companies. Anything is possible in the world. Unexpected things, black swans do happen, and that was a video I wanted to make, and video that brought me these three companies to my watch list. But then again, I am not going to buy any of those if they trade too highly, are overvalued. But I'm keeping them the same as with the biggest moat companies here, as I just told you. Then finally, we have Tesla. Nothing new to update there. Risky company with huge overvaluation, and as I have been saying for a long time. So no more to add there. This is basically my portfolio, my watch list also. This is how I see the company's valuations in relation to their risks at the moment. Please let me know in the comments if you disagree or agree with some of these. Always fun to hear other people's opinions and justifications why this might be. But as said, to summarize this video up, two takeaways I would say. You see my portfolio. I told you that Grex is something really interesting I would like to include, hopefully in the near future, to my portfolio. And then maybe the other takeaway is that I feel like I wouldn't like to say that the risk profile of big tech in USA has gone up, but it kind of has, in my opinion, to be fair. They have increased their capex so much that they are not the same companies as they used to be 5 years ago. So even though I'm saying that even with Alphabet and Meta you could make 10% a year for the upcoming years, that now comes with a little bit increased risk profile too, in my opinion, due to the huge capex. But those would be the takeaways of this video, and let's see next portfolio updates and risk reward matrix coming then at the end of summer, I would guess. Until then, remember to do obviously your own research every time before investing in any company. This video is only made for you to give you some ideas, give you some transparency on what I'm doing, but mainly to give you ideas to start your own research on these companies. No financial advice. You are always responsible of your own investing, as you know. And with that, I wish you happy beginning in summer, first of all, and I wish you good investing in this quite exciting, quite scary world of geopolitics, investing, global markets we live today. But things are exciting, and when the scariness and the fear goes up, that usually means that it's a time for some stocks will crash and might present huge buying opportunities. So this is why you always need to have your watch list ready. You need to always have a plan ready. What will you do if a panic hits the market, if market crash comes? Nobody knows if one comes. Well, there always will be market crashes. Don't you worry about that. It will always happen from time to time. But nobody knows when the next market crash will happen. So you need to be always ready with your watch list so that you have a plan of what will you do when things get crazy. And with that message, thank you for watching this video, and I see you in the next one. Bye bye.